All right, turning now to our chart of the day. If you thought stocks were down bad, check out bond prices, which are down colossally. Data from Bank of America Global Research showing the spill in high-grade debt that's supposed to represent bonds issued by comparably higher quality companies. And by the way, the y-axis is index, not necessarily a price. And it's also, it actually is price, but it's not necessarily bond yields. This is part of the story behind news from ratings agency S&P Global, which said this morning it would suspend its full-year forecast because of an extraordinarily weak bond market. We're actually watching right now shares of both S&P Global and Moody's declining right now. It was actually a little bit steeper earlier in the morning. Volatility is clouding the outlook for both of these companies, which rely on debt issuance as a key moneymaker. But again, as I showed you from that chart earlier, the bond price fall that we've been seeing across the board, even for higher quality companies, has certainly flagged some issues there.
Well, I guess to that point, how much of this is about higher rates? And if it is, how much more downside does that suggest?
Yeah, well, I mean, higher rates is absolutely a big part of this when you consider that if you increase the borrowing costs, even on the short end of things, you're going to see the higher end of the yield curve start to tilt up as well. Interest rates across the board are rising, which makes it more expensive for companies to issue bonds and then get corporate debt out into the market. So if that's drying up as the Fed increases interest rates to who knows where, then that's going to be an issue for a lot of these CFO offices that are saying, well, in the meantime, at least we're probably not going to be able to issue as much debt as we were prior to that.